Markets do not move like textbook curves. In the simplest model, a price path is continuous. It wanders, but it never breaks. The volatility is fixed, like the market has only one weather setting. Then real markets arrive. Volatility clusters. Quiet days come in groups. Violent days come in groups. A calm curve can suddenly become a storm. And sometimes the price does not wander at all. It jumps. An earnings surprise, a central bank decision, a credit event, an overnight shock. The price after the event is not connected smoothly to the price before it. The Heston jump model is built for that picture. Market weather that changes over time, plus sudden earthquakes in the price. The equation looks intimidating, but each term corresponds to one visible feature on the screen. Start with the cleanest benchmark. Black-Scholes assumes the asset earns a risk-neutral drift and receives continuous Brownian shocks with one constant volatility. If volatility is 20%, it stays 20%. Every path is continuous. No gaps, no volatility bursts, no sudden cliffs. That assumption is mathematically elegant. It is also too clean for many option markets. Options do not just care about the average path. They care about the shape of risk. Real option prices imply smiles and skews because the market price's downside moves, volatility bursts, and tail events differently from ordinary day-to-day noise. Heston fixes one part of that problem by making variance random. Instead of giving the price one fixed volatility, Heston gives it a second state variable, VT. This is instantaneous variance. Volatility is the square root of that variance. When VT is low, the price path makes small continuous wiggles. When VT rises, the same Brownian shocks become larger visible moves. The variance has its own equation. It is pulled toward a long-run level, theta. The pull has speed kappa v. If variance is far above theta, mean reversion drags it down. If variance is far below theta, it drifts upward. But variance is not deterministic. It has its own Brownian shock. The parameter psi controls volatility of volatility, how violently the market weather itself changes. There is one more crucial link. The two Brownian shocks are correlated. The price shock and the variance shock do not have to move independently. In equity markets, this correlation is often negative. A drop in price tends to arrive with a rise in volatility. That is the leverage effect. Visually, the curve falls while the variance cloud expands. In option prices, that asymmetry helps create skew. So Heston gives us changing market weather. But the price path is still continuous. It can become turbulent, but it cannot teleport. That is where jumps enter. A jump process is a clock for rare events. We write it as NT, a Poisson process. Most of the time, nothing happens. Then, at a random instant, the clock ticks. The parameter lambda is the jump intensity. It is the expected number of jumps per year. Low lambda means sparse event dots. High lambda means more frequent shocks. When a jump arrives, the price is multiplied by J. If J is 0.85, the asset instantly loses 15%. If J is 1.2, it instantly gains 20%. That is why the price equation uses ST minus, the price immediately before the jump. The model needs to distinguish the left side of the cliff from the right side. The jump size is usually modeled in log form. J equals XP of Z, where Z is normal with mean MUJ and variance sigma j squared. MuJ controls the center of log jump sizes. If it is negative, jumps tend to point downward. Sigma j controls jump size uncertainty. Small sigma j means jumps cluster near a typical size. Large sigma j means the jump distribution has much wider tails. Now build the full model one layer at a time. First, the baseline risk neutral drift, R minus Q. The risk-free rate, R, is the baseline growth rate. The dividend yield Q is a continuous drag on price growth. Second, the Heston diffusion term. Square root of Vt times dWs. This is the continuous random motion of the asset, scaled by current volatility. Third, the jump term, J minus 1 times dNt. If the jump clock does not tick, dNt is 0 and the term vanishes. If it ticks once, the price receives the percentage jump J minus 1. Fourth, the compensation term, minus lambda times kappa J. Kappa J is the expected percentage jump size. It equals expected J minus 1. For a log normal jump multiplier, that is xp of muj plus 1/2 sigma j squared minus 1. Why subtract lambda kappa j from the drift? Because under the risk-neutral measure, the expected return has to behave correctly after accounting for dividends and rates. If jumps have a non-zero average effect, the continuous drift must be adjusted, so the total expected price growth is not accidentally too high or too low. Think of it as balancing the jump contribution before it happens. The model keeps sudden events in the path, but does not let their average quietly distort the risk-neutral drift. The variance equation remains the Heston engine, kappa v times theta minus vt times dt plus psi square root vt times dwv. The first part pulls variance toward its long-run anchor. The second part lets variance breathe randomly. The correlation condition says dws times dwv equals rho dt, tying price shocks to volatility shocks. Put together, the model has two kinds of uncertainty: continuous uncertainty, Brownian motion, always present, shaped by stochastic variance; event uncertainty, Poisson jumps, usually absent, occasionally dominant. Watch a simulated path through this lens. At first, variance is low. The price moves, but the wiggles are narrow. The weather is calm. Then, variance rises. The path becomes rougher. The volatility cloud expands. The same asset now feels more fragile because every small shock is amplified. Then, a downward jump arrives. The price does not slide into it. It breaks. ST minus is the value before the event, and ST after the event is that value multiplied by J. After the shock, variance can remain elevated, and then slowly mean revert toward theta. That slow return is exactly what the variance equation is describing. This is why the model is useful in option pricing. Black-Scholes can price a clean world. Heston can represent stochastic volatility and some smiles. Heston with jumps can represent stochastic volatility, skew, and sudden crash risk in the same visual language. For equity index options, credit-sensitive assets, and markets exposed to event risk, that extra jump layer matters. The main idea is simple. Black-Scholes says prices move through one constant atmosphere. Heston says the atmosphere changes. The Heston jump model says the atmosphere changes, and sometimes the ground itself moves. That is the model. Continuous market weather, sudden price earthquakes, and a drift adjustment that keeps the risk-neutral accounting balanced. Follow for visual math.